You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit TheOptionsInsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right, well, this week we're going to stay with the theme of the last few strategy shows that we did on Options Playbook Radio, where we're just kind of talking about the concept that the markets really have been more volatile than what the marketplace is saying. I think you can make that argument. In other words, the buyers of option contracts have probably outperformed the sellers. Now, that's just a gut feeling for me. I don't have any numbers to back that up. But the news cycle is just so crazy over the last 2 or 3 months that I think we're going to stay with that theme. And that's one of the biggest things about option trading is if you're in an option contract and all of a sudden you're long, hopefully, the option contract, and news comes out, now you just got to get the side right. Correct? So if I'm long calls and the news is good, the market goes up, but we just get this big spike up in volatility no matter what happens with the options. And if you're long premium, in general, that's a good thing. So we've talked about a lot of long straddles recently, and we looked at a couple underlyings that have been in the news recently and have had some volatility. One of them is Boeing. The planes still have not flown in the Boeing space. So that underlying has still been interesting to be looking at long straddles. And then also General Electric. The good old bellwether General Electric is no longer the same company it used to be. And that's had a lot of news recently about cooking books and just in general the stock almost being a penny stock at this point in time of its life. So that stock has really been moving quite a bit also. So I'm going to stick with that theme. So we had a major news event that happened, and a lot of people, don't necessarily think of this company as a tech company, but they don't get talked about a lot in this space as far as the streaming applications. But Roku, the symbol is ROKU, and the company is Roku Incorporated. Well, one of the major cable providers came out this week and said that, well, they're going to just basically give away a black box that would allow you to stream all these channels over your TV. And the stock got really beat up. It's been a great stock, even though you never hear people talk about it much. But over the last year, that underlying stock has gone all the way from approximately 66 to a high of 170 before it got beaten up. And now, over the last couple of days, it's been pushed all the way down to yesterday. It was at 103, and it came up a little bit today. And I should mention that we are taping Options Playbook Radio on Wednesday, the 25th of September. The markets are closed right now. And that stock, Roku, closed at 106.30. It's up $2.77 on the day, or 2.7%. So with that being said, let's look at alternative to the long straddle. What we're going to actually do is, it's a double diagonal, but a lot of people that looked at double diagonals, they think of them as a strategy, as an alternative to an iron condor, where you're buying the back month and you're buying further out strikes, and then you're selling the front month, and you're hoping that the stock kind of stays within a range, and that allows you to capture time premium, much like a long calendar trade will. Now, all diagonal means is that if you look at the board, we're going to be looking at different strikes. If I'm standing down on the trading floor and I'm looking at multi-months, I'm actually looking diagonal from one expiration to the next expiration, and that's where the term diagonal comes from. So what we're going to do is we're going to do a long straddle, but Roku in general is a very volatile stock. If I look at the one-year volatility chart inside the Ally Invest platform, without any major news, just around earnings and just in general for this underlying stock, we've seen the implied volatility on a 30-day basis be as low as 45% and as high as 100%. And that volatility has been throughout the entire year. You see, if you look at the Roku implied volatility chart, you see that it's gone down to 50 and up to 100, and it's done that about more than 4 times just from a general overview of looking at the chart. So we got the same scenario. Obviously, the stock gets beaten up. The long straddle is going to be very expensive, but we've just had the stock come down all the way from 170 approximately, all the way down to 100 based off of this event. Now, this is basically from September 2nd is when it hit its high for the year, and now it's all the way down to 106. So obviously, maybe a dead cat bounce, maybe it continues to go down, but what this news is going to do to Roku, there's really no foresight over the next month or two. So the stock, I think, will continue to have that volatility. And as always on Options Playbook Radio, we're not looking to make recommendations. We're looking to try to learn. When do these type of strategies work? And we have a lot of strategies inside the playbook that we need to discuss. And this is one opportunity this is a trade that we just haven't looked at doing a double diagonal. But we're going to look at buying the long straddle and then selling the wings. And we're going to sell the wings in the short term. So let's get to the trade. So as I mentioned, today the market, today is September 25th. The market is closed. Roku last traded at 106.30, up $2.77 on the day. This stock actually popped up on the radar. We were looking at it for the midday market call, which I do with myself and Michael Kahn on the Ally Invest WebEx platform, but it didn't make the cut. So I thought it would be an interesting stock just in general to talk about on Options Playbook Radio. So we're going to try to do something that is as at the money as possible. We're going to go out to October 25th date. That's about 30 days away. And we're going to buy the 106 call, and at the same time, we're going to buy the 106 put. October 25th expiration, 30 days away, and then we're going to go to the near term, and we're going to, mainly because we're worried about a volatility crunch, we're worried about vols coming back down into a more normal range, and the stock kind of settling into this new price range. So in this instance, on the near-term expiration, we're going to go out 16 days, and we're going to go about 20 points away. And we're going to sell the 86 strike put, and then on the call side, we're going to sell the 126 strike put. So we're going 20 points down and 20 points up. So ideally what we have here is a long call spread and a long put spread. That's one way that you can look at it, and they're going to be diagonal. And then Another way you can say it is that we're long the straddle and we're selling the wings on the short term. So almost an upside-down butterfly. There's just so many different ways that you can talk about this trade when you're looking at a four-legged trade in this underlying stock. So I can do this entire trade for a net debit at the midpoint of $15.30. So we are buying the more expensive options and we are selling the less expensive options. It means there's no additional requirements, but we do have to come up with the $15.30 times 100 or $1,532, and that's going to be our maximum risk all the way up until that first expiration date. If we get out of that trade before then, we don't have any more additional risk on this underlying. And note I went 20 points away, and there's a reason why I did that. First of all, if I look at the 86 strike put, that's trading for about $1. If I look at the 126 strike call, that's trading for about $1.10. As a matter of fact, actually a couple of cents more than the put does 20 points away. But with that being said, if I go 20 points away, that means that if this underlying stock moved that 20 points in either direction, I'm only paying $15.30 for it. So it gives me that opportunity. The spread is wide enough that I can make the profit on the trade if it just gets to my short strike. I bring in some premium. It's going to probably help offset a little bit of the volatility crunch, but we got a chance for a big volatility crunch here. But we're getting at least $1, and I just prefer to do that. We're hoping that this underlying does make the move of 20 points in that direction before that time period. And FYI, we don't really have to worry about earnings here. We're just looking at potential news, just volatility in the stock, other competitors coming in, and the increased competition that may happen over the next 30 days in Roku. So let's recap. So we're looking at doing a long straddle in Roku. Underlying stock's been beat up since September 2nd. It's now trading at 106. Normally, if you're just doing a long straddle, you would buy the 106 call and buy the 106 put. We were looking at the October 25th expiration, which is about 30 days away. And to help offset some of the volatility fears that we might have in this underlying, we're going to actually go out and sell the October 11th 86 put, 20 points to the downside, and then sell the October 11th 126 call, 20 points to the upside, bring in some premium. The total net debit to this trade is $15.30. That means for every 1 by 1 by 1 by 1 double diagonal that we do here, it will cost you $1,532 plus commission. That will be our max risk on the trade. Our max upside is a little bit hard to determine, but we do know that the width of our spread are at least 20 points, so it's $4.70 wider. The spreads are $4.70 wider than what we paid, which is $15.30. So it gives us a lot of opportunity on the upside. Now we just got to hope that the stock is going to move more than that $15.30 that we paid. And here's the bottom line. If you don't think it can make that type of move, don't do this trade. You're doing it anticipating that after a 70-point move, there may be a 15-point move over the next 30 days in this underlying. If you don't think that that's the case, then you don't put the trade on. So that's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like to discuss on the show or a question you'd like us to answer in the program, you can send them directly to me at TheOptionsGuy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. And until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or Search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.